Mutual fund schemes do not provide uniform returns because mutual fund schemes are divided into several categories. The scheme of each category invests in different assets classes. The investment strategy for each scheme is prepared by the mutual fund managers of the company. There are two parts of a mutual fund: equity and debt. Equity-oriented mutual funds category has 11 types, while in the debt-oriented mutual fund category, there are 16 types of schemes. If you're planning to invest in mutual funds, you need to know 9 things about it before doing so. First, let's understand what mutual funds are. A pool is created by collecting money from people like us. The money collected from investors is then invested in securities such as stocks, bonds, money market instruments, or gold and silver. Mutual funds are managed by asset management companies or AMCs. An AMC runs several mutual fund schemes. The investor earns profit or loss based on the performance of the scheme. Those who invest get a share proportionate to their invested amount. It's just like a mutual fund company offering a large pizza, and you invest in your desired slice. Now let's understand where mutual funds invest. Equity funds invest the money collected from investors in the stock market. Debt funds invest in fixed income instruments such as treasury bills, corporate bonds, and government securities. There is also a hybrid fund category, which is a mix of equity and debt. So, how to invest in mutual funds? You can invest in mutual funds either through a lump sum or through a systematic investment plan or an SIP, which is a monthly mode. There are two ways to invest in mutual funds: direct and regular. Under the direct plan, you can start investing directly through the mutual fund's website or office. In the regular plan, you can also invest through a brokerage firm or distributor. In direct investment, you have to pay a lower charge to the fund house, which means the expense ratio is lower. The expense ratio is higher in the regular plan. Don't go for high returns in the short term from mutual funds. Investment in equity mutual funds should be for 5 years or more. Hybrid funds should be invested with a 3 to 5 year perspective. On the other hand, for debt funds, you will also get liquid schemes for one-day investment. And there are also ultra short-term and short-term schemes for investments of 1 to 3 years. You should choose a mutual fund scheme based on your investment horizon. It is important to understand the risk-taking ability before investing in mutual funds. Proper selection of the scheme reduces the risk associated with the investment. Equity schemes carry higher risk because they invest in the stock market. Therefore, investment should be made with at least 3 to 5 year perspective. If you cannot withstand the ups and downs of the market, then debt funds could be a better option for you. Balanced or hybrid funds are a mix of equity and debt funds. These are for investors who want to take advantage of the stock market but do not want to take as much risk as equity. Asset allocation plays a crucial role in reducing losses in mutual fund investments. It involves diversifying the investment across different asset classes such as equity, gold, or bonds. The advantage of this is that volatility of one investment option could be neutralized by the other asset class, which will provide stability to your investment portfolio. For example, when the stock market goes down, usually gold goes up, and this trend is also reversed. If both assets are in your portfolio, it maintains a balance. Instead of putting money in one place, it is better to diversify your investments across different asset classes. Wrong allocation impacts returns over the long run. It is advisable to consult a financial planner or an advisor to choose the right product. But one thing to keep in mind is that you should not stop your SIP. Many times, people get scared by market volatility and stop their SIPs, which is not the right approach. One of the biggest advantages of SIP is rupee cost averaging. Every mutual fund scheme has a net asset value or an NAV, which is the value of one unit of the scheme. When the NAV is low, you can buy more units with your SIP amount. Similarly, when the NAV rises, you get fewer units. This way, the cost per unit gets averaged out. Lump sum investment does not give you this cost averaging benefit. Therefore, never stop your SIP when there is high market volatility. Also understand that returns are not guaranteed in mutual funds. Their returns depend on several factors such as which scheme you have invested in, the direction of market securities, the competence of the fund management team and the investment duration, etc. Do check the past performance of the mutual fund, although it is not a guarantee of future returns. The final point, every mutual fund scheme comes with a scheme information document or an SID. This contains crucial information like investment objective, asset allocation, investment strategy, risk factors, etc. You must go through these at least once. Choose a scheme based on your financial goals, investment period, and risk-taking ability.